In this video, we are going to talk about top growth stocks for 2021. So before starting this video, please like this video and subscribe to our channel for the future updates. The S&P 500 Growth Index had a total return of 33.5% in 2020, price plus dividends, with the best growth stocks doing many times better. Compare that to the S&P 500 Value Index's 1.4% return, which was actually negative on a price basis. Many analysts believe that 2021 would be a better year for value stocks. Marko Kolanovic, the global head of macro quantitative and derivative strategy at JP Morgan, is one of them. In the second half of 2021, he expects the vaccine would boost economic development, resulting in value and cyclical stocks outperforming with lower volatility than normal. However, if the S&P 500 is to meet the bank's estimate of 4,400, growth stocks, such as those in the tech sector, will need to perform well in the coming year. Kolanovic told CNBC, "We have this very ambitious S&P price goal that cannot be reached unless tech also goes up. As investors reallocate from bonds to equities, we believe there will be some very large index inflows into equities. As a result, the growth and momentum segment will remain afloat." Here's a list of the top growth stocks for 2021. Let's start. Number 5. Veeva Systems. Veeva Systems, VEEV, $274.26, specializes in cloud-based software applications for the life sciences and healthcare industries. It's collaborating with some of the companies working on COVID-19 vaccines, including Moderna, mRNA, and AstraZeneca, AZN. Veeva posted $378 million in third-quarter sales in December, up 34% year-over-year and $16 million higher than analyst expectations. Veeva's bottom line came in at 78 cents per share, a penny higher than the consensus estimate. VEEV predicts sales of at least $378 million and earnings of at least 67 cents per share in the fourth quarter of 2020. Both predictions outperformed the consensus. F4Q and FY22 guidance came in above consensus and appears cautious, particularly given that initial FY22 revenue guidance calls for a 19% Y growth deceleration. Veeva's FY22 non-GAAP operating margin guidance reflects the company's increased investment in newer growth factors, such as Data Cloud and MyVeeva, which we believe is the right step, says Jalaria, who keeps his buy rating and $325 price target on the stock. Veeva announced on September 16 that it had formed a board committee to look into becoming a public benefit corporation, which is described as a for-profit corporation with a public benefit intent. Unlike conventional corporations, which have only one legal duty, to maximize shareholder value, Veeva said in a press release. In addition to shareholders' interests, PBCs recognize their public benefit intent and the interests of those materially impacted by the corporation's actions, including consumers, staff, and the society. Number 4. Netflix. Netflix, NFLX, $522.86, had another stellar year in the markets in 2020, posting a 67% gain, more than 3 times the S&P 500's overall return. The pandemic was beneficial to video streaming platforms in general. However, it should be noted that in Q3 2020, Netflix only added 2.2 million new paying subscribers, the lowest amount since 2016. However, don't forget that Netflix plans to add 6 million new paying subscribers in the fourth quarter of 2020, taking its total to over 200 million for the first time in the company's history. The third quarter was a big achievement in terms of free cash flow. It used $551 million in free cash flow in the third quarter of 2019. This year, it was $1.15 billion positive. It had $650 million in free cash flow in the trailing 12 months ended September 30, placing it in a position to finish the year with positive free cash flow for the first time in years. Netflix will end fiscal 2020 with $22.45 in operating income per subscriber, up from $15.58 in 2019. This is based on its outlook for operating income, $885 million, and total subscribers, 201.15 million, in the fourth quarter. Despite increased competition from Disney, Apple, AAPL, and others in 2020, Netflix remains the gold standard thanks to shows like The Queen's Gambit, which has become the streaming service's most successful limited scripted series, with 62 million households watching it in its first 28 days. Number 3. Square. In 2020, Square's $221.16 soared 248% higher. Cash App was a major factor in this. Cash App is the company's program for sending and receiving money, but it has evolved to include banking, saving, and even keeping digital currencies, and it is expected to extend to other goods and services in the coming years. On the strength of Cash App's prospects, Evercore ISI analyst Raina Kumar recently upgraded Square's stock from in line to outperform. She also raised her 12-month price goal to $300 per share, an increase of 86%. Over the next 3 years, Cash App is forecast to increase its adjusted revenue by 36% annually, beating consensus earnings expectations in each of those years. Kumar wrote in early December, Cash App might become a one-stop, disruptive, digital payments bank over time. We believe Cash App's network will continue to develop aggressively with expanded pathways to monetization over time, with P2P, digital wallet, debit card, stock trading, and Bitcoin buying capabilities already in place, and, with its banking license, consumer and SMB lending potential. Cash App has grown into a one-of-a-kind engine. Cash App delivered $2.07 billion in sales, $485 million excluding Bitcoin, and $385 million in gross income in Q3 2020, representing a 574% and 212% increase over the previous quarter. Cash App's gross profit margin in the third quarter was 81%, excluding Bitcoin sales. Cash App accounted for 35% of Square's $1.4 billion in sales in the third quarter, excluding Bitcoin. In 2021, investors should expect this percentage to rise. Number 2. Shopify. By the end of 2020, a $10,000 investment in Shopify, $1,092.40, when it went public in May 2015 at $17 per share will have grown to almost $670,000. During the pandemic, the company's e-commerce site has been in the spotlight as businesses of all sizes scrambled to get their goods and services online. By any measure, the company's third quarter results were outstanding. Total revenues increased by 96% to $767 million, with subscription solutions sales, monthly fees charged to use the company's platform, increasing by 48% to $245 million. Its merchant solutions revenue increased by 132% to $522 million, which represents the revenues it shares for transactions completed on its website. Shopify's subscription solutions revenue increased by 37% to $629 million in the first 9 months of 2020, while merchant solutions revenues increased by a whopping 115%, thanks to a 94% increase in gross merchandise volume, GMV, to $78.4 billion. Shopify Capital, the company's lending division, is one region to watch in 2021. Users of its website will get cash advances and short-term loans. Shopify lends a certain amount of money, and the merchant repays a percentage of their daily sales before the loan is fully paid back. Shopify merchants in the United States, the United Kingdom, and Canada received $252.1 million in funding in the third quarter, up 79% from the same time a year ago. It has advanced $1.4 billion to Shopify merchants since its launch in April 2016. At the end of September, there were about $248 million in outstanding debt. Number 1. Market Access. Market Access, MKTX, $562.78, is perhaps the least well-known company on this list. For those unfamiliar with Market Access, it is a leading electronic institutional bond trading marketplace. It can offer institutional investors the best range of new and core U.S. credit products by concentrating on fixed income. MarketAccess's Auto Execution Tool, also known as Auto 10, is one of the products it uses to assist its institutional investor clients. The product was released in early 2018, and in the company's Q3 2020 conference call, Chief Operating Officer Chris Concannon reported that automated trading volumes had reached $30 billion, up from $23 billion a year earlier. Auto 10 currently accounts for 14% of the total number of trades. It could take a bond trader 30 to 60 seconds per bond to manually validate bond prices. This has been reduced to nothing with Auto 10, saving institutional investors weeks of human capital per year. Businesses that make or save money and time are more likely to succeed. Market access is no different. MKTX's income has increased by 69% in the last 5 years, from $302 million in 2015 to $511 million in 2019. Its net income has more than doubled in that period, reaching $205 million in 2019. The top and bottom lines are up 36% and 46%, respectively, through the end of September. With a total return of 2,770% through the end of 2019, Market Access was the second best performing S&P 500 stock over the last decade. Only Netflix, NFLX, outperformed the others. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.